Good day, ladies and gentlemen, and welcome to the CEB webinar entitled Customer-Centric Lending. At this time, all participants are in a listen-only mode. If at any time during the call you require assistance, please submit your question through the Q&A box on the platform. This event is being recorded for replay purposes and may be made available on the CEB member website. Please contact virtual events at cebglobal.com with questions. I will now turn the call over to Colin Gibbons with CEB. Please proceed.
Thank you. Good afternoon. My name is Colin Gibbons, and I will be the moderator for today's webinar. Our presenters today are Craig Ficardi and Jonathan Moran. Craig Ficardi is a Principal Executive Advisor for CEB Tower Group Retail Banking, specializing in mortgage and consumer lending systems, core banking systems, enterprise content management systems, scoring and decisioning analytics, and business process outsourcing. He covers a wide range of business, process, and technology topics across these disciplines. Jonathan Moran is responsible for global product marketing activities for Earnix. He joined Earnix in September of 2016, bringing over 15 years of industry experience with him. Prior to Earnix, Jonathan worked at both SAS Institute and the Teradata Corporation in pre-sales, consulting, and marketing roles. If you have any questions for the presenters during the presentation, please use the pull-down chat box in the upper right-hand corner of the content viewer. These questions will only be seen by myself and today's presenters. Questions will be answered at the end of the webinar. A copy of today's presentation slides and a replay link will be sent to all attendees later this week. Let's get started. John, over to you.
Thank you, Colin. I'm happy to be joined today by Craig, and I'd like to jump right into our presentation today. So I will be getting us started, and we're going to look at the following topics. First off, I want to focus on changing market drivers that exist inside of lending and retail banking today. What are the opportunities? What are the challenges? Then I want to take a look at customer-centric lending, look at exactly what this is and how you can not only define a strategy, but execute upon customer-centric lending practices. And then finally, we'll wrap up our time today with a product showcase and customer success story example, really bringing to life what we have talked about from a customer-centric lending point of view. So let's jump right in. Our first section really looks at the changing market drivers that exist today. And I'd like to spend a couple minutes talking about this just to really frame our conversation today, right? And so I'd like to cover 5 main points here that we're really seeing in the industry from a retail banking and lending perspective. And the first one is really this concept of agility. Banks and lenders today have to be very much agile. There's a term out in the marketplace that's referred to as agile banking, which really includes the principles of quick, iterative, and collaborative decision-making. This is very similar to agile software development. It often includes changing processes from manual over to digital, thus enabling digital transformation. And really, this idea of agile banking requires the right channels, methods, and calculations to be able to exceed. Now, the next thing that I'll highlight from a landscape perspective is this concept of complexity. The world in which we live, particularly from a marketing perspective, is very complex. I think that you would all agree that at your organizations there are dozens of channels and metrics that you're responsible for, and it can often be difficult to deliver an anticipated, relevant, and personalized interaction with your end consumers, especially while technology is changing all around us, right underneath our feet. The introduction of things like blockchain, Bitcoin, open source, and the Internet of Things are all leaving some banks confused and wondering exactly where to go next. The fourth point I'd like to cover is this idea of context. And being contextually relevant is really the holy grail for banks and lenders. Being able to deliver an offer over the correct channel, device, and point in time can be a challenge. We hear the term omni-channel thrown around a lot with regard to providing context, but really the fact of the matter is if you are omni-channel, you should be able to be contextually relevant, and you have surpassed single-channel, multi-channel, and cross-channel initiatives that you may have. And then finally, the idea of evolution. So the bank as well as the customer are certainly evolving. From a market perspective, according to a recent PwC Global Banking Survey, 55% of bank executives view non-traditional players as a threat to traditional banks and lenders. And from a customer perspective, the hyper-connected consumer of today spans 5 generations, and in their hand they have a device that is a hotline into a brand over a variety of different channels. And with that device, they can either compliment or disparage a brand immediately. And 4 of the top 5 reasons consumers would churn from your bank, perhaps to a non-bank, all relate to customer experience factors. And we see it happening all around us. All of these new business models in the shared economy today, businesses like Airbnb, Uber, and others, put customer experience first. They scale, they make the interaction very easy, and as a result, they are gaining customer traction at an alarming rate. So the question is today, how do you derive insight from the data that you may be receiving to take action and meet all of these challenges that we see on this slide before us? Well, the answer today is analytics, and Craig and I hope to give you some concrete examples of exactly how to do that. Craig?
Yeah, thanks a lot, John, and good day, everybody. Thanks for that insightful and concise business and technology context for our webinar today. But with respect to the specific business and technology issues in retail lending, I wanted to go over a few of those here. Market conditions are generally very favorable. The economy, in fact, is so healthy that the Fed started raising interest rates in the fourth quarter and just raised them again earlier this week. Other than reducing housing affordability, which is harder for first-time home buyers, especially with home prices having appreciated so much, so far it looks like that any interest rate increase will have a smaller impact in the auto lending, personal, home equity, and, and student lending areas. And in fact, just to comment briefly on auto lending, it's been increasing steadily and strongly for 4 to 5 straight years, although it may be peaking this year. And it's also gotten more competitive. The risk factors are increasing, and this creates an ideal environment for improving loan pricing capability. So change in volatility does create opportunity for lending organizations as the supply and demand for different types of loans increases. Speaking of the supply, there's new competition. Marketplace lenders and peer-to-peer lenders are coming up with newer technologies and newer analytics for scoring, evaluating, and pricing customers, and traditional lenders need to do the same thing. For example, in the home equity lending area, where lenders are looking to increase their production this year to help make up for the decline in mortgage lending. But home equity lending has not had a lot of activity, and so it's time for them to sharpen the pricing tools in that particular area. With respect to customers and technology, the biggest challenges for lenders may be the conflict between existing legacy technologies and the need for customer engagement that John also talked about. Legacy systems can impede access to data or the speed with which new analytics may be deployed, yet this is precisely what customers and lenders both want and need. Customers want products and services designed for them, and lenders want to find new ways to originate more loans with better net interest margins and profit outcomes. And so, as we'll see in a few minutes, prescriptive analytical solutions can be can deliver high-gain projects that justify the new IT spending and will deliver return on investment, and that will also deliver better products and experiences to customers. Prescriptive solutions can also positively impact 2 key profit drivers shown here, the efficiency or cost-to-income ratio and the net interest margin. Looking at the efficiency ratio, for example, think about lenders, where you incur wasted expense when you market a product and customers apply, but the loan does not close. That's a problem. That's an issue where prescriptive analytics can have benefit. Now, you can see here that the cost-to-income ratio has been declining the past few quarters, but it's still far above pre-recession levels and current targets, so there's a lot of progress yet to be made. Prescriptive solutions, if they can find the right product at the right price for customers, can increase the loan approval and pull-through rates, which is going to increase these efficiency ratios, but also the revenue for each dollar of expense that's occurred. Similarly, if you look at the net interest margins here, they have finally just started improving or increasing, after a near half-decade-long decline. On the plus side, this increases the room for more price negotiation with customers, yet these margins are still below pre-recession levels. So lenders are looking for, for additional ways beyond, Fed market changes, to move the needle on net interest margins. And the prescriptive solutions are an additional lever for lenders to use to positively impact the margins here and increase profits. And then I just want to elaborate on this net interest margin story briefly with respect to the size of different lenders. And this shows the same data from the FDIC by institution size on a quarterly basis going back a decade. And you can see here that in general, NIMs are lower for Tier 1 lenders and higher for the smaller Tier 3 or Tier 2 lenders. The point is that regardless the size of your institution and your current margins today, all organizations can really move the needle on margin improvement with prescriptive solutions. For a large lender, they originate large volumes. So it only takes a small incremental improvement, such as 5 basis points, to really have a big revenue and profit impact. For smaller institutions, they may have a different mix of funding sources. Looking at cloud-deployed solutions and getting things out there in the marketplace more quickly is also a way to further augment their margins with new pricing-based analytics. John?
Great. Thank you, Craig. So I guess the question really becomes, how do retail banks and lenders really succeed in this rising rate environment? How are they able to take advantage of that and these current conditions as they continue to rise to be able to have more and more success?
Yeah. And so the short answer here is that, investing in those technologies that are going to help you take advantage of the rising rate environment. And, here I show 3 of those technologies from CEB's annual technology adoption and investment survey data. The categories here you can see are automated decisioning systems that are used to deliver product and rate information out to the end customer point of sale or engagement with the employee or in a self-service channel. Also, customer credit decisioning analytics. This is often the heart traditionally of making a loan decision, but increasingly pricing analytics that look at price elasticity of demand, the customer sensitivity to different products and relative to service levels are the 3 categories that we looked at. And so, the survey results shown here are from retail banking executives. And we first asked them if they were adopting these technologies for the first time or replacing these technologies. And those results are what are shown here. Or if they didn't have the technologies at all or had them but were just not in the process of replacing them. And so shown here for those that are adopting these technologies for the first time or are in the process of replacing them, what's the timing of their technology spending in these areas? And you can see that, on average, 3/4 are investing in pricing analytics this year or next alone. So it's clearly a really critical and important area for retail lending organizations in the different lines of business that they operate in across consumer and mortgage finance. In addition, we asked those same retail banking executives with respect to their spend, is it increasing or decreasing? So it's one thing to be continuing to spend and spend more, spend less. But here we can see, whether it's more or less or not, and you can see that for all 3 technologies, in each case, over half of lenders are also increasing their spending year over year from the prior year in those areas. So these areas are important. The majority of executives are spending in these areas, and they're spending an increasing amount of technology on this technology in order to improve their businesses.
Excellent. Thank you, Craig. So this gets us to our second section, really looking at exactly what is customer-centric lending. So we've seen that, rates are rising, the landscape is certainly changing, and this really requires, banks and lenders to take a new approach when actually lending to their end customer segments or even down to the individual customer level. So I think that we're all familiar with how banks have been structured up until this point in time. If you look at the organizational structure of banks, it goes back, 50, 100 years, right, to when they were originally formed. And they've been set up by line of business because that's what made sense, right? Checking, loans, savings, credit, they all have their own P&L and assigned resources. But we know that in order to provide this exceptional customer experience that customers are expecting, things have to be reorganized. They have to be realigned. A holistic approach really needs to be taken, right, where we're looking at all different lines of business underneath the same umbrella. We need to know that what happens in the loan department isn't an enigma to the credit card department and vice versa. And here's the thing. Customers really expect this. They expect one hand to talk to another. As a matter of fact, a recent Harris Interactive poll found that 86% of all consumers will pay more for a better customer experience even if the product or the quality of the service is inferior. So that really speaks to the point that customer experience is very much top of mind.
Yeah, absolutely, John. So let's turn our attention a bit to, how do we implement this shift in thinking and new approach to customer engagement and loan pricing that John's, talking about. And so with the context of, you may be in the finance department, you may represent the line of business, you may be in the IT department or another area of your financial institution, as you begin to work together and think about how would we implement such a solution, I wanted to just present this, basic IT architecture for a lending environment so you can identify what the relevant, operational business and technology issues and changes, are for you. And so if you starting off at the bottom, working your way up, your organizations may have data stores that are typically separate for different types of loans. They need to feed multiple analytical models to analyze different types of risks for different types of customers and products as well, and then deliver that information into the customer interaction cycle, into the sales cycle for a new loan, or potentially even on the back end for portfolio management in the servicing and cross-sell area, engaging with customers, whether it's a retention activity or a cross-sell activity as well. The key points here are that data normalization, so the data can be consolidated and combined and used together. Integrating those data into a common data store are really critical. In that you can see that, analytics here in the middle are at the heart of providing this better customer experience enabled by good quality data. And then finally, pricing helps bring together the different types of data and analytics to determine which customer preferences, products should be really looked at for that customer, and ultimately making the next best offer for that particular customer, and then delivering that out to the customer through the different channels that are available.
Excellent. Thank you, Craig. So I'm interested in surveying the audience. It's time for you guys to participate, and I really have a question that I want to ask you today. What's the most important improvement advanced analytics could help you make in your organization today? And we'll give you a few seconds to respond to this question. All right, so we've closed the poll, and it looks like the top two responses were the ones that gained the most votes. So automating more to improve the speed of analysis and produce new offers as well as react more quickly and more often to market and competitor moves. That actually took the top spot. So we're going to look at that actually later in the presentation, how you can use software and predictive analytics to react to market and competitor moves more quickly and efficiently. So where we want to go next is we want to talk a little bit about how you can use actionable segmentation strategies as well as new analytic methods to really move your organization forward, right? And so let's start with this idea of segmentation, which really leads to improved individualization, right? So how do you set up different components of segmentation strategy to make things really actionable? And I want to go through a few different areas here. The first of which is this idea of creating a customer profile. And I've really segmented this into two different types of customer profile, the operational profile and the analytical profile. The operational profile is really seen as an instruction manual for how to treat customers, and it's very often part of your larger data repository. An analytical profile really focuses on creating an evolving customer-centric view of how to prepare customer information for things like predictive modeling and pricing analysis. So the bottom line here is the analytical profile really feeds into the segmentation strategy, and operational profile really looks at how to treat and deliver offers to customers. So from there, we want to look at next the idea of doing predictive modeling. And I'm sure that some of you are very much familiar with the idea of predictive modeling, but the fact of the matter is it's not just reserved for the largest of organizations any longer. Using predictive modeling to do segmentation really allows brands to identify the most important predictors distinguishing segment membership, and really allows them to understand things like propensities, churn, and other metrics. Predictive modeling and predictive analytics is also the foundation for artificial intelligence areas like machine learning, right? So using decision trees and neural networks, those concepts are now being used in conjunction with classic predictive models to easily interpret future actions to take. So I would urge you to consider looking at this for future segmentation needs, the idea of doing predictive modeling. So we've set up a profile, we've set up and started using predictive modeling to do some of our advanced segmentation. What comes next? Well, maybe the next thing we want to do is be able to look at changes that may occur in customer states. So customer state changes are really an idea of being able to know when something like a lifestyle change or a life change like marital status, death, or other life event occurs, and being able to use that information to help make a better decision, right? So things like customer state changes allow us to see deviations from past trends and should absolutely be accounted for. Now, after looking at customer state changes, you probably want to set up the idea of an event trigger or an event library. And there's really different types of event triggers. There are blatant event triggers and there are latent event triggers. Really, blatant events are events that are fired directly into the operating environment where marketing offers or analysis takes place. So big event triggers might be something like a large deposit, a missed payment, or a credit limit that's been reached. Now, latent events really require what we call a detection engine, where we can look at trending and state-based approaches and then take that information and use it to inform not only marketing offers, but also risk and fraud and those sorts of things. And then finally, the last thing you might want to consider if you're looking at advancing your segmentation strategies and really making them actionable is this idea of performing what's called real-time decisioning. So really, real-time decisioning is the ability to use real-time, historical, and customer profile data all in conjunction in order to test decision logic and serve what we call a next best offer or action into a marketing or operational channel. So imagine the delight when a retail or consumer banker uses all the data that they have available to them to deliver an offer to a customer that may be sitting in front of them in the branch, maybe on the phone with them, or even over the web. That's delivering an offer that is precisely what they need at a certain point in time. Maybe the offer's for a mortgage refinance when monthly spend gets too high within their household and rates are low. Maybe it's a credit product when times are tight from a family budget perspective. And these decisions and next best offers or actions can be surfaced and served in sub-second times, and some of the most mature banks and retail lenders are absolutely doing that. Now, the next thing we want to touch on, Craig and I, is this idea of some of the analytic methods that are being used today. So we've talked a little bit about segmentation, and really segmentation feeds into using advanced analytics. And the first one we want to talk about is this idea of prescriptive analytics, which is really the holy grail of being able to perform analytics inside your organization. Prescriptive analytics goes beyond predictions and really suggests possible decision outcomes as well as the effects of those decisions. So I'm going to let Craig talk a little bit about how retail banks and lenders get to the point of using prescriptive analytics, as well as explain to us the benefits that prescriptive analytics can provide.
Great. Thanks a lot, John. And, we keep peeling the onion, if you will, on this prescriptive analytics in terms of defining it, describing it, and, explaining what it is. And so I want to keep doing that so that, you can understand, regardless of whether you're in the finance area, and the analytics area, operations or IT, what it is and how it's different and how you can, explain it to others and articulate it within your organization to build out new solutions and to take advantage of them. And so this chart here is set up to show prescriptive analytics as the latest stage of solution capability that most organizations can implement and put into production today. And the evaluation of those four levels of capability: manual solutions, descriptive solutions, predictive, that John talked about, and then finally prescriptive, have different levels of capabilities that go into them. That determines, if you look at the chart on the left, the depth of insights that you can derive from those solutions and the quality of the outcomes. How flexible are your outcomes? How contextual can they be when you're engaging with the customer in real time versus your potential outcomes and ability to sell different products is relatively fixed and limited. So let's look at manual solutions. They typically answer fewer questions than the others. The lender is really left with more of a one-size-fits-all approach with respect to product offers. And they may rely too much on the experience of the loan salesperson and the underwriter to determine the correct rate, product, and credit decision for customers. So certainly, the employee experience can be very important in making the right offers. But the challenges there in terms of getting higher up on the outcome chart there is that it can lead to inconsistent decisioning, unknown profit outcomes, or potentially dissatisfied customers as well. So let's build on that, though, since most organizations do have descriptive or predictive solutions today. Descriptive solutions typically look at who is the customer, what products and features do they have, and so there is that level of rules-driven automation into decisioning and product selection, for example, looking at the applicant's, credit characteristics. So the data is available, there is some automation, but banks still struggle with interpretation of the analysis. So there's no predictive ability here. So the lack of predictive ability, again, impedes knowing if you're giving the customer the right product at the right price. So clearly the depth of insights are better and the outcome is better, but we're still not yet optimal. Predictive solutions are effective for some products or many products and, were yesterday's optimal, but they're really table stakes for today. They do use scores for credit or fraud or other capabilities and predictive models and forecasts and can answer questions around the customer's propensity to repay, acquire new credit, likelihood of fraud, and et cetera. But they're not fully contextual. They don't look at the wider variety of offers that that might be offered. And that's what leads us to, finally, to prescriptive solutions here that has both optimal data usability, rules-driven product and borrower preferences, and product features, scores and models inputted, and then optimized offers and, in workflow. And so, it's with these solutions that the workflow can get optimized, and the next best course of action that John referred to can be taken with the customer.
Excellent. Thank you, Craig. So that's a little bit about prescriptive analytics, but let's look at a few more kind of analytical methods that you should be considering as a retail banker or lender today. So the next one I wanted to highlight is this idea of open source. And the fact of the matter is, open source is absolutely here to stay, and it's ingrained at many financial institutions today, whether it's Citi or Cap One, and to the point that banks and Fiserv companies are actually releasing their own open source projects, whether there's models and analytics built in R or Python or Lua. And these technologies are rapidly rapidly replacing legacy systems of yesteryear. And the reason why, they're cost effective, they're easy to use. Open source technologies are often very secure and stable, and they're often much more flexible than your high cost solutions that are out in the marketplace. Now, what else is happening from an analytic methods perspective? Well, you wouldn't be amiss if you were to say that I absolutely was going to mention machine learning on this webinar, and I definitely want to do that. So it's a hot topic right now, but it's rightfully so. Machine learning allows for the combination really of algorithms and automation, and is rooted and came out of predictive analytics. And oftentimes folks talk about the algorithm component, but they don't talk about the automation component. And really machine learning requires three different pillars to be in place in order for machine learning initiatives to be successful. First off, you have to have the data, right? You've got to have model input, historical customer data, and even purchased and third-party data. Second, you've got to have discovery, right? And discovery takes place through that idea of setting up and creating those algorithms. And then finally, deployment, right? You've got to be able to deploy the results of machine learning initiatives. So data, discovery, and deployment. And, Earnix is actually doing quite a few things around machine learning. And, machine learning processes often touch things like segmentation, lifetime value scoring, creating new pricing models, sentiment analysis, and some cognitive computing components. But I wanted to give you a couple of examples of how we're helping clients inside of financial services and insurance with machine learning. So we're working with a Polish Fiserv company right now to predict the probability for them to be ranked the highest or in the top 3 among their competitors, right? So they're using random forest and gradient boosted models to do that, right? So they can understand exactly where they rank and how they can move up and down according to where they want to be. We're also working with a European health insurer to use machine learning algorithms to classify customers for what they call a frequent flyer or frequent fitness program. And this is a fitness program that's based on the customer opting in and allowing this health insurer to collect data off of things like sports watches or Fitbit devices. And then finally, a third way that we're working with companies around machine learning is to look at random forest and gradient boosted trees to predict midterm cancellation rates on policy. So as someone gets through their term on a policy, are they at a high propensity to cancel or not based on what we know about them? So this is done using algorithms and then automated, and those automation notifications are sent out. So machine learning is absolutely a hot topic, and I wanted to bring it to life for you a little bit more. Next up, analytic methods, is this idea of distributed big data. So we've all heard about Hadoop. It was very much a hot topic probably 18 months to 2 years ago. It's simmered down a little bit, but it's still out there and it's still very much present. So being able to replace old enterprise data warehouses with these new open source big data environments is often something that retail banks and lenders are looking at, and then it's allowing them, by using Apache or Hadoop instances, to save quite a large amount of budget per year. And then my final idea here around some new analytic methods that you might want to be considering is this idea of customer-owned open API data. So there's a project out there called the Open Bank Project, and you can Google it after the webinar if you want to look more into it. But really it looks at allowing banks to build out their data profiles on customers through the collection of customer data via innovative financial apps and across different platforms like CRM, regulation, anti-money laundering, and ERP systems, among other systems. So really what this project does is it fosters a customer-centric open innovation ecosystem, and it allows banks to really augment the customer profiles that they carry around their customer set, and as a result deliver better, more relevant, and more timely offers to you via digital channels. So the more that a bank knows about you as a customer, the better the offer they can deliver to you. Craig, I'll turn it over to you to talk a little bit about how these contextual offers really optimize loyalty and ROI.
Okay, great. Yeah, thanks a lot, John. And just one quick comment on that previous slide. It was really great for to me, the bonus information to create some context around a lot of the new analytical methods that are out there, whether they're part of, prescriptive analytics, today or next year. And also, commenting, your case studies around insurance. We're focused on lending today, but insurance certainly has a key role to play in cross-sell and referral in the retail banking world. Especially outside of, North America, but also within North America as well. But I do want to, bring together everything that John and I have addressed, so far today, and have it be a lead-in into the to the demo that and the case studies that John is going to dig into more deeply in a minute. And so, just a quick pictorial here to show how new analytical methods, can work in a typical use case. And so, here you've got, Joe or Jane, customers' typical life cycle that would include acquiring deposit and savings accounts, and then a credit card, early on in their lives. Then they buy a car in their 20s, or earlier if they live in the suburbs, later if they live in the city, and they acquire additional credit cards, along the way. And, at some point, they get married and acquire a mortgage. Certainly there are a number of opportunities to optimize the sale of those products along the way, although I do want to focus on something else. It's also important to note that these loans may be with your financial institution or another one, or most typically your financial institution and other financial institutions. So, and this is where prescriptive analytics can help in the next situation that I want to show you here. So, they've acquired, the house, they've had one car, and it's time for a second car. What do? How do you finance it? They could just go out and get a second car loan, but is that the next best offer for that particular individual? There are potentially a lot of things to think about and a lot of options, and prescriptive analytics can help you help your customers find those alternatives, such as debt consolidation of existing loans with a new loan in order to increase your lendable funds to that customer and to perhaps reduce the combined interest rates for those. And so by being able to have some intelligent advisor, which could be self-service channel or an agent, armed with new analytics, advising the customer on what to do. So you can then offer a more desirable next best offer to an appreciative customer, increase your wallet share, and even if the home equity line of credit option is chosen there in option C, fund the car today, lower the interest rate, have an even lower tax-deductible interest rate, and have an available line of credit for future spend, such as on a vacation. So just to bring together the prior conversations that we've had, and then transition over to John now for more, specific case studies that he wants to show. And just before we get into that, John's going to do one more live poll.
Yes, thank you, Craig. So wanted to ask an additional question. So what is the most important objective you and your organization have in using predictive analytics? Is it cross-sell, profitability, volume increases, optimization of risk, or something else? And we'll give you a few seconds to answer this question. All right, so it looks like the first response, improved cross-selling of existing customers, takes the win there. So I think that this is obviously something that's very important to banks and lenders, right? Getting that next best product or offer into the hands of your customer in order to continue to grow them and migrate them to higher value customer segments over time. And so that's something that's absolutely very important and something that we can absolutely help a lot of banks and lenders do here at Earnix. So I wanted to spend a couple minutes going through just 2 slides on what Earnix does and what solution we provide. So really what Earnix focuses on is allowing you to bring together customer data to lending via a comprehensive platform where data can be imported, predictive and prescriptive models and algorithms can be developed and executed, analytical techniques such as optimization of pricing. And by the way, pricing is just one lever that you as a brand can pull, can be used, and then offers can be executed to the market in a batch or real-time fashion. And then you can, of course, monitor and report on those offer deliveries, whether it's a cross-sell offer or a retention offer or a migration offer, what have you. Couple of key points I want to make here. All of this is fully integrated. So, silos are removed and banks don't have to use numerous systems, Excel spreadsheets and legacy applications to get the answers to often complex questions. So really it translates to an improved experience for the analyst or line of business manager actually managing the process inside of the organization, as well as an improved experience for the end customer through the receiving of a more contextual offer. So this solution allows banks to understand what the impact of rising rates are, right, and understand exactly where the volume to revenue sweet spot lies for them for a particular product or a group of products. We're going to see exactly how that works. I did want to also highlight the fact that the solution is not just for retail banking or a single product or service either. It can be used across the organization, whether it's deposits, lending, audit finance, mortgage, as well as wealth management and S&B. So having the ability to do modeling and decisioning and optimization and scoring and offer creation and delivery across these lines of business gives the bank really a competitive advantage, as well as a holistic view that we alluded to earlier in the presentation. And the fact of the matter is customers expect this. They expect the banks and lenders to have that holistic view. So with that, I wanted to jump into, I think this is one of our last questions here. We've got this one and then one more that really looks at, how are you as an organization performing behavioral and pricing analytics today? Is it via a base analytics platform? Is it via Excel? Is it via a comprehensive platform? Or is it a combination of the above? And I'll give you a few seconds to answer that. All right, and it looks like that, as expected, some combination of the above was the was the answer. So I would imagine that, a lot of folks are using base SAS and then maybe taking the models from SAS and putting them into Excel, or perhaps a pricing analytics platform of some sort, or maybe it's just more of a generalized platform. But I think that, we would absolutely market the idea and message the idea that a comprehensive pricing analysis platform is certainly something that could be of value to you and your organization. So let's bring it to life. Let's look at how a comprehensive pricing analysis platform actually benefited one of the customers that we're working with. So this is an example from an Italian banking group. They're a banking conglomerate that is one of the largest conglomerates in the country of Italy. And really, they had a challenge where they were issuing personal loans, and they were issuing about $250,000 each year, and they were assigning a standard markup rate to every single loan. So whether or not you had, a couple €1,000 with the bank in assets, or if you had, over $1 million, you still received that 5% standard markup on that loan. Now, what Earnix did is we actually came in and we helped them to enable differentiated pricing for their entire personal loan portfolio. So they have the ability now to perform randomized price testing, understand the volume to revenue trade-offs that they need to make in order to maximize net revenues, and really understand what rate's too high for a certain customer, what rate's too low for a certain customer. And they started with personal loans, but they're moving to every single department inside of their bank. And what's the result been for them? Well, they were able to increase their net revenues to the tune of 30 basis points across the entire portfolio. Their net interest margins went up about €600,000 month over month, and the adoption of a customer-centric pricing strategy, just as we're talking about today, has resulted in a value for them of €35 million over a span of 3 calendar years. So over 36 months, €35 million gain there. So that was just one example of some of the work that we're doing with banks out there with regard to pricing analysis, pricing optimization, and really optimization of that entire customer experience. All right, so that's a case study. Next up, I wanted to take it into actually looking at the product in more detail. So let's bring this product to life. And we've mentioned a number of times now that we're able to help do things from data management to analytical optimization to decisioning and execution. And I really wanted to run you through our newest product, which we call Links. And the Links product actually focuses on the component that I have circled here. So model optimization and taking results to a pricing committee or something like that in order to enable changes in the portfolio or the business book. So let's take a look at exactly what we have here. So we're going to look at Links, which is our optimization UI that you see on the right-hand side of this slide. Now, underneath this user interface, we have what's called the Earnix engine, which allows your statistician or your analyst to set up data and models and really run those and iterate upon those. What we're going to look at is the ability for a line of business manager or a business executive to have the power to simulate new scenarios and accurately predict the answers to those what-if questions that might exist inside of banks today. So let's take a look at this interface. So we'll start here at our logon screen, and a couple things I want to mention here is this is a cloud-enabled interface. It is customizable by user and persona, so multiple users and personas can use this, and we can customize the underlying data as well as what's surfaced in the interface to meet the needs of your organization. When we log in, we see a dashboard straight away. Again, this dashboard is set up by individual user, and we can look at key performance metrics here, right? So banks want to look at things like, overall performance, loan amount, customer application volumes, gross lending broken out by product, conversion rates on mortgages, things like that. And I will mention that we're looking at a demonstration instance that has been configured for a U.S.-based mortgage provider. So, looking here, we can look at things like, loan amount, and we can see that it's below target here. We can look at application volumes and see that, our application volumes are above target. We can look at gross lending. We can see that it's a bit below where we want to be from a month-over-month perspective. And then we can look at conversion rates, and we can see that we're slightly below our 70% target, right at 67%. So this is really a lens into the business at a very high level, and we can see that, okay, performance isn't where we want it, lending's not where we want it. What do we need to do in order to not only have more people come into the bank, but really convert more mortgage applications and get them through underwriting and actually out to the market? How can we do that, and how will that increase our total gross lending? So from here, we might go into the part of the software which we call the what if, right? And so there are two different things that you can do, right? You can perform what are called what if scenarios, and then we can do what we call solver, or solve for certain issues. So let me explain a little bit the difference. So the what if component is used for small tweaks to products you already have in market, and lets you see what happens when you make subtle changes to products offered, whether you change demographics, channels, rates, fees, etc. The solver, on the other hand, works out the optimum way for you to achieve a goal and gives you more power to manipulate some of the constraints using models that lie beneath the scenes in our Earnix engine. So in the what if functionality, as we see here, we're able to tweak things like rates and fees on a single product or a group of products, and then we can understand the impact that will have on volume and revenue targets. So what we're looking at here is we've selected a certain customer segment here. We've selected certain channels. We have the ability to select certain channels. We can select certain products we want to focus on. And like I said, it can be an individual product or a group of products. We can look at a certain type of loan. Maybe we only want to look at mortgage loans that are 80% loan-to-value mortgages. We can look at minimum loan amounts, and then here we can set up the changes, right? Maybe I want to drop the rate on a mortgage loan, or maybe I want to drop an application fee or a legal fee associated with a mortgage loan. What impact is that dropping, or is that changing going to have on my entire book of business? And then from a solver perspective, we can look at a certain goal that I may want to reach, whether it's getting to a gross lending number of $300 million as we see here, or if it's just maximizing gross lending by a certain point in time. I can do that, and I can set that up. And then I can add in what we call constraints. So, any good optimization scenario involves the ability to include constraints that I may have as a business, whether it's, rate caps or something like that. So in this instance, I'm looking at, setting up loss ratios and return on asset numbers in order to meet specific goals. So I can set those up, run those scenarios, and then the result of that is actually simulation results, right? So it actually shows me in this business user interface exactly what's going to happen. Well, if I lower rates and I lower fees, then, average loan amounts as well as application amounts are probably going to go up, right? And as a result, I'll probably process and convert more mortgages, and my gross lending numbers will go up. So it's things like that that allow us to understand the impact of those changes. And if you have a certain place that you need to get to from that volume to revenue trade-off perspective, you can continue to modify the scenarios that we just looked at in order to get to that point. So that's a little bit about the simulation results component. Now, I can look at statistics around, how am I doing from a channel, segment, market, and product perspective, and I can see my actual versus my predicted here. And I can also look at, if you look to the right of the statistics in gray, you'll see something that says rates. I can actually look at my rate sheets and modify those and see exactly what the downstream effects of rate sheet changes are going to be. So that's a very quick look at how I can use this user interface to simulate results, perform optimizations, solve for certain constraints I may have as a business. I can then save that information off. I can take it with me into a pricing committee meeting. I can even open this software and use it in front of the pricing committee if I'd like to, because it's not difficult to understand. It's easy to interpret the results, and people can clearly see what the impact of rate and fee changes are going to be. So that's a little bit about the Earnix product. Hopefully that provides some insight into exactly what we do and how predictive and prescriptive analytics can work for you at your organization. If I wrap up with anything, I'd like to wrap up with this, right? What are the key takeaways from today, and how can you put these things into action? So I think that the three takeaways for today, and I hope you got this as well, was number one, that markets, customers, and business models are absolutely changing. Rates are rising, customers are evolving, and business models are really being reshaped to emphasize customer experience. I think that Craig did a great job of demonstrating the fact that analytics can actually bridge that gap from data to insight and from insight to action. So predictive and prescriptive analytic techniques are available, and analytical segmentation strategies and new analytic methods are being used to improve the results that organizations are seeing. And then finally, I hope you realize that the results are absolutely real. The results of analytics are real. So, they result in better margins, improves customer loyalty and understanding, and increased customer satisfaction. So what should you do today? What should you take away from this? First off, I would say, go back to your organization and really understand what market, customer, and model drivers are affecting what you do inside of your organization, right? And make sure that you can assess where you reside on that maturity model that Craig shared with us. Are you at descriptive or diagnostic analytics? Are you in the realm of predictive? Or are you ready to tackle things like prescriptive analytics and take a look at what strategies and technologies you may be able to advocate for or advise your organization use today? And then finally, if you have questions, please feel free to research and then reach out to us. And with that, I'll wrap up with one last question for the audience here. Is there anything you would like to receive today? We promise that we will send this to you. We will not spam you, but we would be happy to share collateral or research that we have that might benefit you. All right, great. Well, thank you for that information. With that, I will wrap things up. On behalf of Craig, thank you very much for your time and attention. If we have time for any last-minute questions, we can certainly take those now.
Great. Thanks, Craig and John. So we have come to the top of the hour and won't have time for any Q&A. For those of you who did ask questions, though, we will follow up after the event. As a reminder, a PDF copy of today's presentation slides and a link to the replay will be sent to all attendees later this week. On behalf of Earnix and CEB, we thank you for joining us today.
Ladies and gentlemen, thank you for your participation. That concludes today's conference. You may now disconnect and have a great day.